Well, traders are always concerned about volatility, of course. It has a lot to do with their success in trading. And our guest today is John Netto. He's going to talk about volatility in S&P markets and the equity markets in general. John, thanks for being here.
Thanks for having me, Tim.
All right, so when you're looking at volatility and the VIX these days, how does it affect your trading decisions?
Well, it's important that as a trader, when you're setting your profit targets and you want to set objectives every day, that you have a context of the playing field that you're on. If you're driving on the freeway and the speed limit's 65, well, going about the speed limit means going 65, 70, or 60 for those of you out there. When it comes to understanding the market, if the S&P is trading in a 12-point or 11-point range and it's already moved 8 points on the day, understanding the volatility or what the implied volatility says about the market can really give you some insight as to maybe where you should be taking profits. These are levels that big money, billion-dollar institutional levels pay attention to. These levels often coincide with when you've reached an average one standard deviation move, often coincide with Fibonacci levels, market profile numbers that are used by several traders out there. So coming into the day and being prepared and knowing, okay, what is the recent market range in the last 20 days? What's the recent market range in the last 5 days? Where are we right now relative to that range? If I'm looking to take a trade, how does all of that set up? It's something you want to pay attention to. And so when you look at volatility, it's understanding what we've done in the past and what we might do in the future as well.
So I know that when traders set arbitrary stops of, say, 1.5 or 2 points, they're also not considering that if the market's already moved that far, they may not have that much room, or if the average true range is not there to support that, maybe they should be thinking in a percentage. Would you agree with that?
I would agree with that. And that's why, as a person that uses Fibonacci levels work as a great means to proactively anticipate market volatility. If I'm looking to buy a 382 retracement or a 618 retracement, that's based on the market move that's just happened. So Fibonacci serves as a great de facto mechanism to enter positions that still provide me a decent out, because I can use the fib levels to also set my stop, and they naturally take into account volatility of that underlying market that I'm trading.
All right, as we head into the end here of 2010, what are your thoughts about the volatility of the market, whether it will slow, speed up? What do you think?
Well, I think we need to understand contextually what a high volatility market typically is correlated with and what a low volatility market is associated with. High volatility markets are no more associated with fear, concern or anxiety about where the market's going, poor fundamentals, possibly economic woes to come, other geopolitical risks that might be out there, whereas complacency or lower volatility is typically associated with there's a comfort level. People are feeling good. There's a lot less fear in the market. There's more complacency in the market. So as seeing a market that has recently broken out to multi-month highs, it appears that we're dealing with actually a market with lower volatility, filled with a few spots where we get some big up moves. So being the markets look more bullish right now, being that the reflation trade is as strong as it is, we're seeing gold set multi-month highs, we're seeing crude oil break back near highs again, a number of underlying financials and the advanced decline line showing is very bullish. I think we're going to see less volatility, but that means you have to adjust your strategy accordingly.
How about we have elections coming up?
Sure.
Would short-term, a week before, a week after, do you sense increased volatility then, and how do you trade that?
I think actually we'll see more compressed volatility. I think that the positions people have will be taken off and wait till the elections reconcile themselves. At that point in time, if there is in fact the Republicans take back control of the House again, or even possibly the Senate, I think that's very Wall Street friendly. There's a sentiment out there, whether it's accurate or not. The present administration is not the most Wall Street friendly administration we've had in the past, and so Wall Street's seeing the fact the elections, at least the polling data we have, can be very positive for the market. But nonetheless, though, most people, whatever positions they take on, they'll probably begin to maneuver out of, and I would anticipate a little bit of compression of volatility before the election's finalized. From there, we'll then see more year-end allocations and people setting up their trades for 2011.
John, thanks for your time.
Thanks, Tim.